Fed doesn't know what it's doing, do they?
Well, they don't know what they're doing next. I'll leave it to other people to argue whether they know what they're doing.
You know
but
what
they don't know what they're doing next. So they've got a meeting coming up next week. And I think a lot of people came out of their January meeting thinking that they were ready to launch QE3. But the story we have today is that they're not. The finger is not hairline on the trigger. It's not ready to pull.
Do you think the stock market's been weak over the last week or so, kind of uncertain, because it was betting on QE3, and now it's clear that the economy is strong enough that maybe they don't need it?
I think that the chairman of the Fed testified 2 times last week, and the message that he sent was that he's not ready to pull the trigger. So there might be an air of disappointment. I think the market, especially the stock market, tends to look at the Fed's bond buying programs as free candy, right? They, it seems that the past few years, every time they launch one of these programs, the market goes up, and when the Fed thinks that when the market thinks that the Fed's ready to do another one, they're expecting 3 points. That's a line. That's all they need.
Now I know you cannot. You are very bright, very clever, and very good looking. I should add.
You got to stop that.
Now, but can you explain to me why treasuries today, in a day in which China came out and said economic growth won't be as robust as we were forecasting, in which their factory orders were down in the U.S., the treasury market yields are actually rising. Treasuries are off. Explain that to me. Why?
I'll give you a very simple explanation. Never look at one day and say that one piece of news could explain everything that happens in any particular market, because there's a lot of things going on in the market. Maybe the Treasury market was overbought a few days ago when people were unwinding their position.
But
so I wouldn't read too far into that. But it's also
these markets tend to be highly correlated.
It's also the case that we had a story today. I don't know if this is part of it. I haven't really looked at what the Treasury market's doing today, saying the Fed might not do another round of bond buying, so that might have some impact on the market. There's a lot of other issues going on.
What has to happen for QE3 to be triggered? By that I mean the Fed. Wait, just wait 1 second. Let me finish my question.
Sorry.
The Fed said, we had GDP growth coming in at 3%. They're projecting for the last quarter, I think, of last year. They're projecting 2.2 to 2.7% at the Fed.
Yeah.
Does it have to be more than that to trigger QE3? Less than that to trigger QE3? What are there triggers?
See, that's the golden question. That's what a lot of people are asking. Let's lay out 3 scenarios. There's the Fed's forecast. They say around 2.5% GDP growth this year, and unemployment not moving any lower than it already has. One scenario is that the forecast is right. Another scenario is that the forecast is wrong and the economy does more poorly than they're projecting. The other is that the forecast is wrong and the economy does better than they're projecting. Well, for the latter two, if the economy does more poorly than they're projecting, we could very well get another round of bond buying. If it does better, we're probably not going to get another round of bond buying. The big question is, what do they do if they're actually right? And that's the part that they're not prepared for. What do they do if we get kind of middling 2.5% growth, no more improvement on unemployment? Then they have a really intense debate, and I have a lot of fun writing about it, because there are different factions at the Fed. Some of them are going to want to do more, and some of them aren't, and Bernanke is going to have to make a call. One of the points in my story today is that they haven't made that decision yet. They're sitting on the fence and watching how things play out.
The market right now, as well as a lot of observers, and they think that is the most likely scenario, right? I mean, that is the kind of base case. The base case is middling growth.
Right.
Unemployment comes down a bit, but not a huge amount.
Right.
And the economy kind of churns along.
It's the Fed's base case and it's the market's base case. And if we get it, then we're going to be having this discussion again in April, May, and June. I think probably what we see is a few more months. They want to watch the data play out for a few more months, and then as we get into the spring and into the summer, they start saying, all right, our forecast was right. Do we need to do more? And then the other piece of this, which we haven't talked about, which is very important, obviously, is inflation and inflation expectations. If the growth forecast is right and inflation is soft, this gasoline price spike that we've seen kind of settles off, it becomes easier for them to do it. If the growth forecast is right, but gasoline prices keep rising, oil prices keep rising, and they don't get headline inflation below their 2% objective, the argument becomes more intense and they might not do it.
Final question for you. And Liam Denning is coming on just after this to talk about oil and gas prices and how it will impact the economy. But does China matter to the Fed? Do they
Certainly.
look? I mean, do they look at what China projecting slower growth? Does that? I know they take everything into account.
Yeah.
But is that like a a very small variable, or is it a big variable?
China matters a lot on many levels. It was Bernanke came out with this theory a few years ago that we had a global saving glut where all this money, China was recycling all this money back into the United States, and that is what was pushing our rates lower. He pays a lot of attention to that. If global growth is weaker, exports have been one of the stronger points in our recovery. If that means we're not going to get as much on the export front, then yeah, they're going to be paying attention to that.